Rich Saperstein out with his best ideas for the year list. We got 3 stocks on this list. Rich, let's start with Microsoft. Why did it make your list?
Well, Microsoft should be a core holding in anyone's portfolio because it's really the intersection of the cloud and software along with gaming. They've had a 17% compound annual growth rate. As I mentioned previously, cash flows have increased basically 100% over the last 3 years, and there's low cyclicality to the company. And I just think every investor should have some participation in the cloud. It's the major superhighway of the world.
We mentioned one of your new buys earlier in the show, coming from the defense space, Northrop Grumman, excuse me. But Lockheed's on your list too for the new year. Why?
Well, Lockheed's, come down from a PE basis from 24 down to 17, one of the lowest it's been trading at. And that's enabled the multiple of the cash flow. It's selling at roughly 8% of cash flow. That plus the fact that they have a $140 billion backlog, again, $65 billion in annual sales. And they're right in the mix of what is being, sought after by all governments around the world that are increasing their defense budgets. They're delivering HIMARS over to Ukraine, and they're the leading proponent for the U.S. in hypersonics.
Jimmy, both are in your wheelhouse, obviously, but I don't need you to tell me all the reasons why you like Microsoft, because they're probably similar to why almost everybody seems to like Microsoft. But what about this Lockheed?
It's a good call. It's a good call.
You own that and Raytheon, right?
I own Boeing and Raytheon.
Boeing and Raytheon.
When you put all these together, there's a lot of overlap. And look, I'm just going to call it like it is. And I hate the way this sounds. But as Rich said, defense budgets are growing. And what are they growing for? Missiles, which you get in Lockheed Martin and you get in Raytheon. And airplanes, fighter jets, which you get in Boeing, which you get in Lockheed Martin and Northrop Grumman. I hate the world that we're living in. But we're living in it, and we got to deal with it. And that's where there's going to be top-line growth for the foreseeable future.
Rich, we go back to energy, too. Canadian Natural Resources, that's the last of your 3. Tell us.
Yeah, $63 billion oil company in Canada largely completed its CapEx program. Now, if you look at the numbers, their operating cash flow is 22% a year. They spend a little bit on CapEx. They have 16% free cash flow, which is unbelievable. So what are they doing? They're reducing debt and they're returning it to shareholders. Their leverage ratio is very low at 1x. Their extraction costs are roughly $30 a barrel, and it's a great position company to own.